With continued concern about a looming U.S. recession, seems like a good time to consult the latest U.S. Federal Reserve macro snapshot. Our chief equity strategist and economist, John Blank, has been doing that, and he's here to help with that now, give us some interpretation of it. John, we're talking about the Fred macro snapshot, right? That
Yeah,
updates quarterly, correct?
correct. Actually, it's real-time updates there. You can go on their Fred website to macro snapshot, and they'll give the real-time macro update.
Okay, so let's take the snapshot components one at a time here. First, what's it looking like for the U.S. GDP for the year? We just got a big macro number out, headline number.
Yeah, 5.2% for the third quarter, 2.1% has come out finalized for the second. So that was a massive jump. And it was the upward revisions were led by consumption. So the summer to the fall, we had, a lot of revenge travel and spending and people getting on with their lives, whether it's drawing out excess savings or just feeling comfortable to have jobs. I think people need to understand that when people have a low unemployment rate and there's a plethora of jobs, people are confident not only they will keep their job, they go find another job. And this does raise people's forward confidence on their spending. They say, hey, it's fine, my job's fine, and they do spend. So I think one of the mistakes people are making here who are calling for recessions is not realizing a strong job market actually lifts consumption more than you think.
Then we have the gross domestic income component. That's a component of the GDP, right?
Correct. So, for example, in the third quarter, 5.2 was the number for gross domestic product. 1.5 was the number for gross domestic income. So you average that out, you get about 3.3. And that's probably the right way to do it. The way to think about things is gross domestic product is all production. It's basically a supply measure, includes what the government spends, with the investment, and then consumption. Income is on the other side. It's actually what people have in terms of incomes. That is a real number, real domestic income. So you take out prices. Of course, prices have risen 20% across the last 3-4 years. So those are weaker numbers. That's the kind of place where people are saying, hey, I got the income, I got the job, but the prices I'm paying for stuff are, knocking it down a little on my sentiment. So that's the mix. So the number you might want to keep in mind for the third quarter is 3.3 because that's the average of the two.
All right, so the snapshot also looks at labor market conditions, consumer price inflation. Just this morning, we got new data on personal consumption expenditures, which came in line with expectations. So what's the underlying story with those components about the health of our economy?
Well, we've got a broad number at 3%. And a core number at 3.5%. You generally see those the other way around, that the broad is higher than the core. And the reason is right now we had good traction downward in gasoline prices in October, and that took the number to 3% year on year because of the gas and food is in part of that broad number. In the core, we're at 3.5%. And that 3.5%, Terry, is 1.5% or at least 1%. Let's give the Fed a 2.5% expectation versus 2%. We've got another 1% on the core PCE rate to erode before the Fed gets out of the way. One way to look at it. The other way to look at it is a 3.5% core PCE rate. The Fed likes 1% real rates. That's the restrictive level they like. That's 4.5%. We're at 5.25%, 5.5%. So there is logic, if this sticks, that we will see 75 basis point reduction in the Fed funds rate sometime in the next year and a half. And that is being priced into stocks right now. And that is what you saw over the last month or so.
Does today's inflation reading support a soft landing in the economy?
I think it does, Terry, because the basic difference here, why people have gotten the recession called wrong, is this has been a recovery from a supply shock, not an aggregate demand management issue. So really, in our lifetimes, unless you are 120 and lived through the Spanish flu in 1920, 1918, you never understood a supply shock from an influenza, infection and epidemic, virus epidemic, whatever, until now. So that shuts economies down globally in the U.S. That snaps supply chains, if you remember the port bottlenecks and all that stuff, or you even tried to shop for an appliance back in the day or a car. So that just takes time for all that stuff to normalize and wind down. And that has been, the slow improvement over time of prices while the economy rises. You don't generally see that because you've always lived through demand management, not ever a supply shock and its recovery.
Does other new economic data out earlier this week alter the Fred snapshot at all?
I would say not really. It's mostly in line with what they have. I think, you're looking at a fourth quarter forward GDP now, which does incorporate those real-time numbers at 2.1% for the fourth quarter. So what they're telling you is don't expect the third quarter and the fourth quarter, but actually expect trend real GDP growth over long term to stick around in the fourth quarter, which is the message you should get.
Even though the latest published analytics show an increase of just over 7% in Black Friday merchandise sales, and Cyber Monday sales were pretty good as well, you wrote that the Christmas holiday shopping season could be more about experiences and services spending rather than a focus on goods spending. Why?
That's correct, Terry. I think, one thing you got to think about, we all have jobs and we're comfortable, that we're going to keep our jobs. What we can't do, for example, we saw pending home sales, down to March 2020 COVID levels because there's no thing to buy out there and houses, no inventory. And we also know there's a lot of, people sticker shock with what a car payment's going to do when you have a 10 to 12% loan rate. So people are staying out of cars, staying out of houses, and that means they're buying other stuff like travel and services.
You noted three major consumer leisure revenge travel stocks. I don't know what the revenge travel stocks mean, but you can explain that. Namely, Royal Caribbean Cruises, Sands China, and Live Nation Entertainment.
Yeah, so revenge travel is real simple, Terry. I was sitting in my house for 2 years, and they didn't let me leave the country or get on any type of travel. Everything was shut. So Royal Caribbean's classic. I couldn't do a cruise, back in the day. Just to give you an idea of what happened to the stock, it was at $130 a share in, February of 2020. It was $25 a share 2-3 months later. Right now, Royal Caribbean is at 106. We're still got another 25% to go to get to the highs, which are, by the way, 1, 2, 3, 4 years ago. So 4 years ago, we started this whole COVID adventure. And now Royal Caribbean is the number one rated stock. So this is fascinating. This is the revenge travel. You said, hey, I didn't get to do that trip. Now I'm going to do that trip no matter what. So what happens to earnings? 6.6660 a share in 2023, $9.05 a share in 2024. Huge step up. And it's not an overpriced stock at 16 times earnings. From what friends of mine tell you, if you try to get on a cruise right now, they're all sold out. So that's classic revenge travel.
Okay.
Sands China, this is Macau, Terry. And the news actually is that, basically Mark Cuban sold his Mavericks to the lady that owns a good chunk of Sands China. But what you see here is, the typical malaise in China. There's no interest in the stock. It's got one analyst following it. Makes $1.20 a share, and it hasn't gone anywhere in 4 years. So this is the story that we still have not seen any strength out of Chinese leisure interest. So it's kind of a U.S. thing, this whole revenge travel thing. I think that might change in China, but it's not being picked up, at least in the Macau gambling scenario. Live Nation, ticker
LYV.
LYV, yeah, LYV. This is the number one ranked stock, Terry. I got $84 a share. Again, back in the 2022 period, I got $125 a share. People are going to concerts. The next thing people are doing a lot of, because it's $100, $150 at most for a ticket, maybe $50. You can get out in the evening and enjoy a concert, and get out with your friends, and get out with the human race again after all these years of sitting around. So Live Nation's ticket sales have been strong and are even getting stronger for next year. Again, $150 for earnings this year, $230 next year. So great estimate revisions going up 35%, Terry.
It's our chief equity strategist and economist John Blank on just what the Fred macro snapshot says about our economy. And with John, I'm Terry Ruffalo, and that's going to be it for John and I for the rest of the year. We're going to take the month of December off. Want to wish you, our listeners, happy holidays for whatever it is you celebrate, and a happy new year, hopefully, for all of you. Meantime, check out this special report, Zach's 7 best stocks for the next 30 days. You can download this just released report that names all of the tickers for only $1. Go to Zacks.com/promo for details.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.